Well, there's been a lot of talk lately about what happens next in gold and silver now that this Iran story keeps jerking the market around from one headline to the next. So, in this video, we're going to separate signal from noise, and you're going to walk away feeling a lot clearer about what may matter over the next few days, what may not, and why the bigger picture for precious metals still has a lot more going on under the surface than one scary headline at a time. It's Wednesday, April 8th in New York, and before we go any further, comment what day and date you're watching from. And quick note, if you value this kind of straight, no-nonsense breakdown, support it by subscribing and commenting John A.G. Best. So in case you haven't seen the setup I'm talking about, here's the basic issue. We've got a market that has been reacting to every twist in the Iran conflict, every rumor about a deadline, every suggestion of a pause, every sign of retaliation, every move in oil, every move in the dollar, and then people try to squeeze all of that into one instant conclusion for silver and gold. Ceasefire, metals moon. Escalation, metals crash. Oil down, metals up. Oil up, metals down. And on the surface, I get why that sounds clean. It sounds tradable. It sounds simple. It sounds like all you have to do is pick the headline and you know the trade. But the problem is markets usually don't stay that polite for very long. Because yes, there really was a conditional pause announced. Oil really did get hit hard on that news. Risk assets really did breathe a little easier. Gold and silver really did wake up sharply after getting rattled earlier. And yet, at the exact same time, the people who actually watch energy flows for a living are still saying the market may keep a geopolitical premium for a while, even if the shipping lane reopens, because trust does not come back in one press release. Recently published energy forecasts are still carrying a risk premium in crude for the months ahead, not just the next 5 minutes. So right away, we need to slow down a little bit. The near-term setup, in my opinion, still comes down to two broad paths, and maybe the market lands somewhere in the messy middle. One path is that this ceasefire language turns into something real enough for traders to believe for more than one session. Not perfect peace, not a fairy tale. Just enough stability for the market to think, okay, maybe the worst immediate supply panic has backed off. If that keeps holding, then yes, it makes sense that oil can continue taking some air out of the blow-off move. The dollar can lose some of the emergency bid it picked up during peak fear, and metals can catch a bid from a slightly different angle than the usual panic trade. Not because the world is fixed, but because the market starts pivoting from survival mode into repricing mode. And the other path is that this thing slips right back into threats, attacks, retaliation, and last-minute brinkmanship. If that happens, then welcome back to the chaos. Oil gets yanked around again. The dollar gets jerked around again. Precious metals get shoved around again. And silver especially, because silver never just walks through a storm like gold. Silver runs, stumbles, overreacts, recovers, and then does it all over again. That's why I want to be careful with the too clean version of this story. A lot of people hear ceasefire and instantly think that must be bearish for gold because fear is fading, but that is not automatically true. And a lot of people hear escalation and instantly think that must be bullish for gold and silver because war equals metals up. That also is not automatically true. Sometimes escalation boosts the dollar so much, or pushes rate fears so much, or sparks liquidation in leverage positions so fast that metals get smacked first and only later recover. We have seen that movie before, so what matters is not just the headline. It is the chain reaction behind the headline. Let me show you what I mean. When the latest ceasefire announcement hit, oil fell hard. Hard enough to remind everybody how much fear had already been priced into crude. At the same time, gold rebounded sharply and silver jumped even harder. That tells you something important. It tells you the market was not only trading fear of war, it was also trading fear of inflation, fear of disrupted energy, fear of policy mistakes, fear of a messy macro backdrop where nothing gets easy. And once you understand that, you understand why the metals response is not always the cartoon version people expect. Now, if we zoom out just a little, this gets even more interesting. Because from recent market updates, the Fed is now staring at exactly the kind of setup precious metals investors have to pay attention to. Higher near-term inflation pressure from energy, mixed growth signals, and no painless policy response. The New York Fed's latest survey showed year-ahead inflation expectations jumping, with gasoline expectations making one of their biggest moves since the energy shock tied to the Ukraine war. And at the same time, a senior Fed official literally described the current backdrop as a stagflationary kind of problem, where there is no obvious cookbook. That matters a lot, for very good reason. Because when the market stops believing monetary policy is simple, gold and silver stop being side characters. So yes, watch the headlines, but do not act like the whole thesis begins and ends with one deadline. Now let's talk silver specifically, because silver is where people are getting the most emotional. Silver has had an absolutely wild ride. It ripped, it got everybody excited, it pulled back hard, it shook out people who bought late, and now it is sitting in that very uncomfortable zone where bulls think the reset is healthy and bears think the top is already in. That is exactly the kind of zone where people lose discipline, because they stop analyzing and start projecting their feelings onto the chart. And when I look at this kind of structure, I think the better way to see it is not as one dramatic verdict, but as a pressure zone. Price surged, then price corrected, then the range started tightening, then every bounce got sold a little less cleanly. Then every dip started finding buyers a little sooner. That does not guarantee a breakout. Nothing does. But it does tell you that the easy part of the shakeout may already be behind us. A lot of traders call this a falling wedge. Fine. Call it that if you want. The exact label is not really the important part to me. The important part is what the behavior usually says. The range narrows, emotion burns off, late momentum money leaves, stronger hands begin building again, and eventually the market is forced to pick a side. Now, could it still break lower for a while? Absolutely. Silver loves humiliating certainty. If broader markets seize up, if yields jump, if the dollar rips, if peace headlines reverse overnight, silver can absolutely get kicked around again in the short run. Anybody telling you otherwise has not spent enough time with this metal. But if you are asking whether a violent run, followed by a nasty flush, followed by compression near an important area can become the launch pad for another leg higher in a broader bull phase, the answer is yes, that is a very real possibility. And I think that is why this part of the chart has people so locked in. Because once silver starts building a base after a dramatic move, the conversation changes. It is no longer just about whether the top is in. It becomes about whether the market has already done the hard work of throwing out weak conviction holders. That matters because silver is not just a story asset. It is also a temperament test. The weak hands always show up near the worst possible moment. They get excited near the highs, terrified near the lows, and exhausted right when the structure starts improving again. And then, once enough of them are gone, silver suddenly starts looking stronger than people expected. Not because magic happened, because the ownership changed. And there is another layer here that I do not think gets enough attention, and that is market structure. A lot of people only look at the big printed spot number and stop there. But if you are trying to understand stress, confidence, and timing in a metal like silver, you also have to look at how the futures curve is behaving. Earlier in this episode of Volatility, people were obsessing over whether silver looked backwardated, whether nearby demand was pulling ahead of deferred pricing, whether that meant some kind of shortage signal, whether that meant paper had finally lost control, all of that. Right now, if you look at the current futures board, the front part of the curve is not screaming panic in the way some people were hoping for. The nearby month and the next month are still sitting in a modest contango structure, not a dramatic dislocation. That does not mean the market is loose. It does mean we should be careful about exaggerating every little structural wobble into a once-in-history event. And this is where I think people can get themselves in trouble. Because if you want silver to go higher, you do not need to invent a fantasy collapse in the entire pricing mechanism every other week. Sometimes a bull market climbs because the fundamentals are tight enough, investment interest returns, macro conditions get supportive, and the market simply reprices higher over time. That is a lot healthier than rooting for some spectacular breakdown that would probably bring a whole mess of unintended consequences with it. The other thing I notice in moments like this is how quickly mainstream coverage still centers everything except silver until silver absolutely forces itself into the conversation. Gold gets the safe haven label, oil gets the scary headline, the dollar gets the emergency reaction, equities get the drama. Silver kind of floats around in the background until it moves so hard that nobody can ignore it anymore. In a weird way, that may actually be part of why silver produces such violent catch-up behavior. It stays underfollowed right up until it doesn't. And I think that helps explain why sentiment around silver can feel so fractured. One crowd sees it mostly as a precious metal. Another crowd sees it mostly as an industrial input. Another crowd sees it as a monetary protest asset. Another crowd sees it as a momentum vehicle. The truth is, silver carries pieces of all of those identities at once. That makes it messy. But it also makes it powerful when enough of those narratives begin pointing in the same direction. Gold, by contrast, is easier for institutions to understand. That is part of why I think gold can sometimes lead the way in serious macro phases. Gold does not have to explain itself as much. Central banks already understand it. Large asset allocators already understand it. It has an established role in reserve management, collateral discussions, risk hedging, and crisis behavior. Silver usually needs a little more storytelling. Gold just needs the macro backdrop to get uncomfortable enough. And if you want proof that gold is not some sideshow asset, look at the liquidity. According to recently published liquidity data, average daily gold trading volumes remain enormous on a cross-asset basis. Pair that with official sector demand, and you get a market that is not only emotionally important but structurally important. That is why I think any discussion about future money, future collateral, future settlement systems, or future confidence anchors keeps circling back to gold, whether people like that fact or not. Silver benefits from that conversation too, just differently. It is almost like gold opens the door, and silver decides whether to sprint through it. Now here's where I want to push back on one piece of the easy bull case. I do not think it is enough to say solar demand exists, therefore silver must only go one way. That is too lazy. That is not analysis. That is cheerleading. The long-term solar story is real. The energy transition story is real. The power security story is real. The official energy outlooks still show massive renewable capacity growth through the rest of the decade, with solar doing most of the heavy lifting in that expansion. That absolutely matters for silver. But there is a catch. Silver is expensive enough now that manufacturers are actively trying to use less of it where they can. Recently published industry reporting showed the solar industry accelerating efforts to thrift and substitute silver as costs rise. A widely followed industry outlook also says industrial fabrication is expected to ease this year, partly because photovoltaic producers are trying to reduce silver use. So if you want the adult version of this thesis, here it is. Solar is supportive, but not infinitely supportive. Demand can stay strategically important even while technology works to reduce intensity per unit. Both things can be true at once. And honestly, that does not weaken the silver thesis as much as people think. Because even with that pressure, silver is still expected to remain in structural deficit again this year, which would make it another consecutive year where demand outruns supply. That means the market does not need some fantasy scenario to stay tight. It just needs enough demand from enough places for long enough. Investment demand can do part of that. Industrial demand can do part of that. Electronics can do part of that. Grid build-out can do part of that. Physical bar and coin demand can flare up when confidence breaks. Silver does not need one perfect pillar. It has multiple engines. And that leads us into something a lot of Western market commentary still underestimates. Price discovery is not a one-city game anymore. If all you ever do is stare at one Western paper reference and assume that tells you the whole global truth of precious metals, you are probably missing more than you think. Over in Asia, local premiums and physical market signals can tell a different story. India has already shown, at various points this year, that it is willing to trade precious metals at a meaningful premium to global reference pricing when local dynamics tighten. China keeps reminding the market that physical appetite and official sector behavior still matter. This week, fresh public reporting showed that China's central bank has now kept adding to gold reserves for a 17th straight month. That is not a small signal. That is not random. That is a major central bank continuing to treat gold like something worth accumulating, even after a huge run. And then you look at Shanghai. According to the latest publicly available exchange data, the Shanghai Gold Exchange still shows silver references that, once translated into dollar terms, sit materially above the kind of paper pricing Western traders obsess over. Now, I'm not saying one price instantly erases another. Markets are more complicated than that. Taxes matter, local rules matter, contract structure matters, delivery rules matter, currency matters. But if one part of the world keeps showing a higher willingness to pay for physical metal than another part of the world, you should at least pay attention instead of pretending that spread means nothing. That is why I think the East versus West angle is more than a talking point. I am not going to sit here and tell you that London and New York suddenly no longer matter. Of course they matter. They still matter tremendously. But I'm also not going to pretend the old pricing hierarchy is as unquestioned as it used to be. When physical markets in Asia remain active, when local premiums open up, when central banks keep buying, when investors keep asking what is real and what is just leverage paper churn, the center of gravity starts shifting a little. Maybe not all at once, but it shifts. And that bigger shift matters for how you think about gold and silver long term, because this is not just a chart story. It is not just a war story. It is not just an oil story. It is also a money story. A lot of people still make the same basic mistake. They look at gold and silver through the lens of what the dollar did this week, instead of looking at the dollar through the lens of what money itself has been doing for years. And once you flip that around, the whole discussion changes. Gold and silver are not valuable because the internet got excited. They are not valuable because one chart looked bullish. They are not valuable because a few commentators say mean things about fiat. They are valuable because they sit outside political promises in a way paper systems never fully can. Now, do I think that means dollars disappear tomorrow? No. Do I think that means the current system just snaps in a single clean moment? No. Real systems usually decay in uneven, frustrating, drawn-out ways. But that does not mean the decay is fake. It just means it rarely moves in a straight line. And the macro backdrop right now still looks like the kind of backdrop that keeps metals relevant. Energy shocks are feeding inflation pressure. Policymakers are nervous. The Fed is boxed in. Crude may have dropped fast on the ceasefire announcement, but official energy forecasts still carry a meaningful risk premium because supply restoration takes time and confidence takes even longer. When energy stress hangs around, it bleeds into transportation, production, sentiment, consumer budgets, and politics. That kind of environment does not make hard assets disappear from the conversation. It keeps them there, and gold especially has the institutional sponsorship to stay in that conversation. From recently published market data, gold demand hit record levels last year. The metal logged dozens of new all-time highs, and central bank buying stayed durable even as prices ripped higher. On top of that, liquidity data still shows gold sitting among the world's most liquid major assets. In other words, this is not some fringe market people only run to when they are wearing tinfoil hats in the basement. This is a deep, global, strategic market, and the official sector still treats it that way. That is why I think one of the more interesting parts of the current discussion is not whether gold is important. It is whether the financial system starts finding new wrappers to reconnect itself to gold more openly. You have probably heard versions of that idea floating around. Stable structures, bond structures, tokenized structures, settlement structures, collateral structures. Some of that is hype, some of it is noise, but some of it points to something real. People keep trying to marry the credibility of hard assets with the convenience of modern financial rails. That does not mean every proposal is smart. It does not mean every idea becomes policy. It just means the urge keeps coming back, which tells you the system itself knows credibility is in demand. And that's where gold has an edge in the institutional imagination that silver doesn't always get credit for. Gold is already treated, officially and unofficially, like reserve-grade collateral. Silver has more industrial torque and more volatility, but gold has the cleaner monetary reputation. Put those together, and you start to see why both can work in the same portfolio logic without being the same trade. Gold is the steadier monetary metal. Silver is the more temperamental hybrid. Gold usually gets respect first. Silver often gets chased later. And when silver starts outperforming after gold has already reopened the door, that can be a very interesting part of the cycle. So where does that leave us over the next few days? I think the short answer is this. If the ceasefire holds well enough for the market to believe the worst immediate energy shock is backing off, then the path of least resistance probably remains lower in crude, softer in the emergency dollar bid, and constructive for gold and silver, though not necessarily in a straight line. You could still get intraday shakeouts. You could still get fades. You could still get traders selling the first pop. But the backdrop would be friendlier than it was at peak panic. If the ceasefire unravels and we go back into direct escalation, all bets are off in the very short term. Oil can spike again, the dollar can catch a fear bid again, rate fears can come back again, and metals can get hit first before they get loved again. That would not shock me at all. In fact, that is probably the piece too many newer precious metals traders still underestimate. The first move is not always the final move. And under either path, I still think the bigger macro picture remains supportive over time. Why? Because even a de-escalation does not erase the inflation psychology that has already been stirred up. Because even an oil drop does not instantly rebuild confidence. Because even a calmer week does not change the fact that central banks are still buying gold. Because even a softer demand patch in one industrial bucket does not erase a multi-engine silver market running through repeated deficits. Because even if solar uses less silver per panel over time, the scale of global build-out is still enormous. And because once the market starts realizing policymakers are navigating politics, energy, inflation, growth, debt, and credibility all at once, hard assets stop looking old-fashioned and start looking practical. That is the part I do not want people to lose sight of. Do not let the daily noise hypnotize you into forgetting the long game. There is a reason investors keep coming back to this space after every flush. There is a reason official buyers keep showing up in gold. There is a reason silver keeps finding support even after brutal corrections. There is a reason physical market signals matter. There is a reason energy shocks keep dragging metals back into the macro conversation. And there is a reason every time confidence in the system gets even a little shaky, people start rediscovering what real assets are for. Now, one more thing, and this matters. If you're successful, share your success story in the comments so others can stay motivated. That matters because markets can feel lonely, especially when volatility is high, and everybody online acts like they knew every move in advance. Most of them didn't. Most of them are reacting, just like everybody else. The difference is whether you react emotionally or whether you keep your framework. And my framework right now is pretty simple. In the near term, I am watching whether this geopolitical cooling is real enough to keep oil from immediately ripping back higher. I am watching whether the dollar loses some of the fear bid or grabs it back. I am watching whether silver can keep tightening instead of unraveling. I am watching whether gold continues to behave like a macro hedge and not just a headline toy. I am watching whether real-world inflation pressure keeps policymakers boxed in. And I am watching whether physical market signals from Asia continue telling a firmer story than a lot of Western commentary wants to admit. If those things line up the right way, then this current reset in silver may eventually look a lot more constructive than it feels in real time. And if they do not line up right away, that still does not destroy the larger case. That's the key. Short-term confusion does not equal long-term invalidation. You can have a messy week and still have a bullish thesis. You can have a nasty shakeout and still be in a broader uptrend. You can have a ceasefire that helps metals. You can have an escalation that hurts metals at first and helps the thesis later. You can have stronger solar growth and stronger silver thrift efforts at the same time. You can have official gold buying and retail silver volatility living in the same market universe. Reality is allowed to be more complicated than a thumbnail. So, no, I do not think the entire future of gold and silver comes down to one headline tonight. But yes, I do think the market is at one of those moments where the next few sessions can shape sentiment in a meaningful way. And when sentiment is this fragile, you do not need a final answer. You need a disciplined way to interpret what comes next. If peace keeps gaining credibility, watch how metals behave even without panic. If conflict comes roaring back, watch whether metals absorb the hit better than people expect. If silver keeps building instead of breaking, that matters. If gold keeps acting like a strategic asset while policymakers keep looking uneasy, that matters too. And maybe most important of all, keep remembering what game you are actually playing. If your whole thesis is one headline, you will get whipped around. If your whole thesis is one pattern, you will get whipped around. If your whole thesis is one influencer's certainty, you will definitely get whipped around. But if your framework includes geopolitics, inflation psychology, policy risk, physical market signals, central bank behavior, energy dynamics, and the difference between short-term reactions and long-term repricing, then you at least have a chance to stay grounded while everybody else is getting tossed across the deck. That is how I see it right now. We've got a market that may calm down a little on the surface while remaining structurally tense underneath. We've got gold with real institutional sponsorship. We've got silver with a tighter, more explosive personality and still supportive supply dynamics. We've got energy markets that may have backed off the cliff edge without becoming normal. We've got policymakers staring at inflation pressure they do not fully control. And we've got a global market that is slowly, unevenly, maybe stubbornly, starting to admit that old benchmark assumptions are not the only benchmark assumptions that matter anymore. That does not mean tomorrow is guaranteed green. It means the story is bigger than the panic. So keep your eyes open. Keep your position sizing sane. Keep your emotions on a leash. And keep paying attention to what is actually changing, not just what is trending for an hour. And that is why patience matters here. Because the market may still throw one more fake move, one more scare, one more euphoric squeeze, before it reveals whether this is just relief trading or the start of something much more durable underneath. Thank you for spending your time here with me. Take care of yourselves, take care of each other, and I will see you in the next video. And just as always, this is for education and perspective, not personal financial advice. I'm sharing how I'm reading the setup, not telling you what to buy or sell. Every asset class carries risk, every market can humble you fast, and you should always do your own work before making any money decision.